India VIX just hit an all-time low. Most traders are celebrating because the market is calm and going up, but thinking this is the best time to sell options, they think. But if you're an option seller, this is exactly when you should be scared. Low VIX doesn't mean low risk. It usually means hidden risk. Okay, let me break it down. India VIX is the market's fear index. It measures how much volatility traders expect in the next 30 days. High VIX means panic and expensive premiums. Low VIX means calm and cheap premiums. Right now, everyone thinks the market will hit all-time high because the market is again going up slowly and steadily. So if I go to Nifty, you can see for the past few days we have been just going up and up and up, and everyone thinks the market is doing very well and we will just go up and up. But this is where you should start thinking in the risk as an option seller. Right now the market is saying nothing big will happen, but the problem is market doesn't send you a calendar invite before the chaos arrives. The moment the steady upside goes down, the moment it starts going down, the VIX will start spiking up because it is unusually low. It's the lowest it's ever been. I will show you the chart in a bit, right? So but first we will talk about the illusion of safety. The moment the Nifty starts going down, the VIX will spike, the option premiums will suddenly spike, and the options that you have sold will gain 2-3 times more value. So it will just be a mess. All right. So now we will go step by step. When VIX is low, option premiums shrink. For sellers, it looks safe. You think, all right, the VIX is low, I will just sell options and collect premium. It works until it doesn't. You sell a bank Nifty straddle or a Nifty straddle and you collect about 120 rupees premium. Market looks flat and you think, all right, easy theta decay, and you just made a lot of money. That is the catch. That works until it doesn't. One small gap wipes you out. All right. And even if you don't trade gaps and you just go intraday, even in intraday you are not safe. There is no guarantee that the market is flat like this and the next candle the market makes is 1% down. That 1% is enough to wipe out your entire account. And let's take an example in 2017. All right, 2017 is when the India VIX also hovered at record lows. Sellers were minting money daily. Then February 2018 came along, global volatility spiked, and in one session weeks of profit evaporated of option sellers. That is how big of a VIX spike happened that time. And here is why ultra VIX is dangerous. You are underpaid for risk. Premiums don't reflect real world events. A crude oil shock, a Fed rate surprise, a geopolitical headline can instantly spike volatility. The market doesn't know what can happen in the world today or tomorrow, all right? And after that, the second thing, the gap risk explodes. With the low premiums, there is no cushion. One gap against your position and your tiny 5 rupee profit is gone and replaced by a 200 rupee loss. And 200 into 75, you can calculate how much that is. And it gives you a false confidence. Low VIX is told by everyone that low VIX is good, low VIX is good. And it invites people selling bigger size. All right. That is why blowups happen, because people start trading the biggest amount of lot sizes in the low VIX session, thinking that all right, the market is calm and we will just sell more options and make more money. No, this is the exact thing that causes the blowups. This is the false confidence I'm talking about. Now I will go over the trading view chart and show you. So this is a trading view chart of India VIX. I have removed the VIX which is over here. So as you can see, I've removed the wick of the candles because it kind of cleans the chart, and I need that because the wicks on the India VIX chart is quite messy and it won't make sense. So I've removed that, and now you can see I have marked this white line which indicates the last all-time low, which was about here. And in the 2017 case I was talking about was here. The India VIX was at record lows, which is about 10. And after that, within days, just days, VIX shot up 50%. And in 2018, it shot up all the way 100%. In days, just look at this day, 10% this day, 10% that day. And in single days the market shot up 10%, and that 10% is enough to wipe out your account, trust me. And now let's take another example. Let's take this. uh, Again at 10, in just 4 weeks, or sorry, 4 days, it shot a 50%. I won't include this because this was the COVID spike. I won't include that. In 2022, again, sorry, 2021, again at lows, like really low, and just in days or weeks, 170%. Then here, all right, wait, I won't include that because that was the elections, so I won't include that. Let's include this. From here to here, that is again about 60%. So, and we are back at all times low. We have actually closed at a really, really low. For the first time, we have closed at about 9.8850. That is incredibly low for IndiaVIX. If I shift to the monthly chart, I think you will understand how low we are. The last low was in 3 July 2023. And before that, it was in 2017. So we have officially broken that and closed below that. So what it means for today. Right now, straddles and strangles look super, super cheap. But buyers see them as lottery tickets and sellers think they are easy money. But remember, option pricing is like an insurance. If the premium feels cheap, it's not because the risk is disappeared. It's because the market stopped charging for it. You are not selling options at a fair value. You are selling that at a discount to people waiting for the next storm, all right? The smart buyers have started buying. They know the premiums are really low, so they are buying yearly options. Uh, Now I will tell you how to survive this and what smart sellers can do. First of all, reduce your lot size. You don't need to increase your lot size. I know your profits will be cut in like half or what, but trust me, my profits have also fallen a lot. I mean, I haven't gone into loss, but my profits, which used to be at about 3 lakhs per month, have fallen to about 2.5 to 2.2. All right. So don't chase the same lot size you used in high VIX regimes. Now, second point, hedge with cheap OTM options. So if you are collecting 100 rupees, spend 20 rupees on insurance. Net credit is smaller, but your account will survive in case of a spike. Or third, this is something most people won't agree with. Just sit it out. Just don't trade. Professionals know when to not trade. And in fact, sitting on cash during ultra low VIX can be the most profitable decision in the long term. I know a lot of people won't agree with this, but it is an option you can take. So don't celebrate this all-time low India VIX. For option sellers, this is not free money. This is just a scam. And one spike is all it takes for entire accounts to disappear. It's the perfect setup for a blow up, and the calmest seas usually hide the biggest storms. So if you want breakdowns on how I am positioning during low volatility regimes, you can join my Telegram in the description. It's free. I don't have any tips. It's not, any paid course on anything. It's just raw market structure analysis. So yeah, stay sharp and I'll see you tomorrow. Thank you for watching.